Right now, while you're watching this, there is a federal report being filed on an American who just withdrew his own money from his own bank account. He didn't break a law. He didn't cross a threshold. He just pulled cash in a pattern that a piece of software didn't like. And he has no idea that report exists. Somewhere else, a woman has $400,000 in savings at a single bank. She thinks every dollar is insured. It isn't. If that bank fails tomorrow, and not in the way Silicon Valley Bank failed, she loses $150,000, gone, not stolen, just uninsured. Because the exception that saved SVB depositors, the government already said they won't guarantee doing it again. And right now, a payment system called FedNow is processing transactions across the country in real time, 24 hours a day, 7 days a week. And 94% of Americans have never heard of it. Don't know what it does, don't know what it records, don't know where it's headed. 6 rules, 6 changes, exposed in public filings, published in the Federal Register, buried in IRS guidance documents, and ignored by almost everyone who will be affected by them. If you have a bank account, a savings account, a Venmo, a PayPal, a crypto wallet, or a safe deposit box, this video is about your money. Specifically, it's about the 6 things that changed about your money while you weren't looking. Every single thing in this video is public record, published, documented, verifiable. This is not speculation. This is not a conspiracy theory. This is what's already written into law, already in effect, and already being enforced. Whether you know about it or not, we're going to walk through all 6, what the rule used to be, what it is now, why it matters, and what you can legally do about it. But I need you to stay for the whole thing, because these 6 rules don't just exist in isolation. They connect. And the pattern they form when you lay them side by side is something most Americans will never see unless someone walks them through it. That's what this video does. The survival maxim. The first rule of financial preparedness has nothing to do with gold, ammunition, or a bunker in Montana. It's simpler than that and harder to follow. Know the rules before the rules know you, because by the time a regulation shows up in your life uninvited, it's already too late to learn what it says. Disclaimer, quick note before we dive in. This video is for educational and informational purposes only. Nothing you hear is financial advice, legal advice, or tax guidance. I am not your accountant, your attorney, or your financial planner. Consult a licensed professional before making any decisions about your money. Rule 1. The cash trap. Why your ATM habits are already on file. Here's a number most Americans think they know. $10,000. That's the threshold. If you walk into your bank and withdraw $10,000 or more in cash, the bank files a currency transaction report, a CTR, with the Financial Crimes Enforcement Network, FinCEN. This has been the law since 1970 under the Bank Secrecy Act, over 50 years, nothing new. And most people hear that number and think, okay, as long as I stay under 10,000, I'm fine. Nobody's watching. I'm under the radar. That is one of the most dangerous misconceptions in personal finance. Because there's a second reporting mechanism that most people have never heard of, and it has no dollar threshold at all. It's called a Suspicious Activity Report, a SAR, and unlike a CTR, which triggers at a specific amount, a SAR is triggered by pattern, by behavior, by anything the bank's compliance software, or a single teller having a gut feeling, considers unusual. Here's the part that should make you sit up. The definition of unusual has expanded significantly. Under current FinCEN guidance, if you withdraw $3,000 on Monday, $3,000 on Wednesday, and $3,000 on Friday, all under $10,000, all perfectly legal individual transactions, your bank's anti-money laundering software will almost certainly flag that as structuring. And structuring, the act of deliberately breaking up transactions to avoid the CTR reporting threshold, is a federal crime under 31 U.S.C. Section 5324. Not a fine, not a warning letter. A federal crime carrying up to 5 years in prison. Let me say that again. You do not have to move $10,000. You do not have to do anything illegal with the money. You just have to move your own legal cash in a pattern that a computer interprets as avoidance, and you have committed a prosecutable federal offense. And the expanded FinCEN guidance hasn't raised the threshold or narrowed the scope. It's gone the other direction. Banks now file SARs on a broader range of behaviors. Patterns well below 10,000, unusual deposit frequency, and any activity that appears inconsistent with the customer's known financial profile. In plain English, if you've been depositing your paycheck via direct deposit for 3 years and suddenly start making regular cash deposits of $2,000, the system notices. It doesn't ask why, it flags. So what do you actually do? First, stop trying to be clever with withdrawal amounts. If you need $8,000 in cash, withdraw $8,000 in one transaction. Do not break it across 3 days. Do not spread it across 2 bank accounts. That is the textbook definition of structuring, and it doesn't matter that your reason was perfectly innocent. Second, if you're making a large cash withdrawal for a legitimate purpose, a used car, a home repair contractor, an estate matter, call your bank ahead of time. Explain the purpose. Banks are staffed by humans who file SARs. A customer who calls ahead and provides context is treated very differently than a customer who walks in unannounced and asks for $9,000 in hundreds. Third, keep receipts for everything. A paper trail proving cash went somewhere legitimate is the single most effective defense against a structuring inquiry. The rule hasn't changed. The enforcement has. And that distinction is what catches people who thought they were being careful, when what they were actually being was suspicious. But at least the money sitting in your account is safe. Your bank is FDIC insured. That means you're covered, right? Rule 2. The safety net with a hole in it. FDIC and the guarantee they won't repeat. FDIC. 4 letters. Americans trust more than any brand on the planet. Established in 1933 during the Great Depression after thousands of banks failed and millions lost everything. The promise: your deposits, up to $250,000, are insured, per depositor, per insured bank, per ownership category. Since its creation, no depositor has lost a penny of insured funds. Not one. That part works. The part people misunderstand, the part that shifted in March 2023, is what happens above that limit. When Silicon Valley Bank collapsed, it was the second largest bank failure in US history. SVB had a specific problem. A massive percentage of depositors held balances well above $250,000. Mostly tech companies with payroll accounts holding millions. Under normal FDIC resolution, those uninsured depositors would have been in line behind the insurance fund, waiting for whatever the FDIC recovered. 60 cents on the dollar, maybe 70, maybe less. But that's not what happened. The Treasury, the Federal Reserve, and the FDIC jointly invoked the systemic risk exception, a special provision allowing regulators to protect all deposits, including above the limit, when a failure threatens the financial system. Every SVB depositor was made whole. Every dollar returned, and the public reaction was, see, the system works, nobody lost anything, which is true. For SVB in March 2023. Under those exact conditions, here's what the FDIC has said since. And this is the part you need to hear. The systemic risk exception requires a 2/3 vote of the FDIC board, a 2/3 vote of the Federal Reserve Board of Governors, and approval from the Secretary of the Treasury in consultation with the President. Every single time. It is not automatic. It is not a standing policy. Multiple FDIC officials have stated publicly that SVB should not be treated as precedent. The next bank that fails, even a large one, may not receive the same treatment. Concrete terms: you have $400,000 in a single individual account at one bank. The bank fails. No systemic risk exception is invoked. Only $250,000 is insured. $150,000 enters the receivership process. You get in line. You hope. Historically, uninsured depositors and non-systemic failures recover 50 to 80%. That is not a guarantee. That is arithmetic and hope. What do you do? First, understand your actual coverage. It's not just $250,000 per bank. It's per depositor, per ownership category. Single accounts, joint accounts, revocable trusts, retirement accounts. Each carries separate coverage at the same bank. One person, properly structured, can be covered for well over $1 million at a single institution. Second, if your savings exceed the limit at any one bank, split across multiple FDIC-insured institutions, or use IntraFi, formerly CDARS, which automatically distributes deposits across a bank network, each portion under the limit, while you maintain one relationship. Third, credit unions, NCUA insurance at the same $250,000 level. Fully insured, structurally independent from the FDIC system. A credit union as a secondary institution gives you genuine diversification. The FDIC limit didn't change. What changed is the demonstrated willingness to go above it, and the public clarification that what happened with SVB was an exception, not a new rule. Your money is in the bank. You understand the insurance. You know how cash withdrawals get flagged. But here's a question most people aren't asking. How you move your money. The actual infrastructure underneath every transaction. That's changing too. And this next system is already live. Rule 3. The invisible rails, FedNow, digital dollars, and the end of slow money. In July 2023, the Federal Reserve launched a new payment system called FedNow. If you've never heard of it, you're not alone. There was no Super Bowl commercial, no mainstream media blitz. It launched, went live, and the vast majority of Americans have no idea it exists. FedNow is an instant payment system. Banks and credit unions can send and receive payments in real time, 24 hours a day, 7 days a week, 365. Before FedNow, interbank transfers went through ACH, 1 to 3 business days, or FedWire, which was fast but business hours only. FedNow settles in seconds, anytime, any day. Weekends, holidays, 3 in the morning. On the surface, pure convenience. Faster payments, faster access to your money. No more waiting for direct deposits to clear. But every FedNow transaction runs through the Federal Reserve's own infrastructure. Every payment has a sender, a receiver, an amount, a timestamp, and a permanent record. Unlike handing someone cash at a farmer's market, there is zero anonymity in a FedNow transaction. That's not a conspiracy. That's how digital payment rails work. Now, FedNow is not a central bank digital currency. That distinction matters, and I want to be precise. FedNow moves existing dollars between existing accounts. It doesn't create a new form of currency. It doesn't give the government new controls over how you spend. It's a plumbing upgrade. But the CBDC conversation runs in parallel, and you can't discuss one without acknowledging the other. The Federal Reserve has been researching a digital dollar for years. Congress has introduced legislation on both sides, some pushing development, others like the CBDC Anti-Surveillance State Act seeking to block it. As of now, no US CBDC exists. No legislation authorizing one has passed. That is the factual reality. But the spectrum is worth understanding because here is the line. Cash, physical currency, is anonymous by default. You hand someone a 20, no record in any federal database. That's not a bug, that's a feature of physical money. FedNow, digital bank-to-bank, is fast, efficient, and fully recorded. Standard for any digital payment. A hypothetical CBDC, depending on design, could be fully programmable. Some models proposed internationally include expiration dates on currency, geographic spending restrictions, and categorical spending limits. The issuer could theoretically set conditions on how, when, and where the currency is spent. No US CBDC exists, but the distance between instant digital infrastructure and programmable government-issued digital currency is measured in policy decisions, not technology. The technology is already built. What this means for you right now: no FedNow exists. Your bank may already route payments through it. Understand that every digital transaction creates a record: FedNow, Venmo, Zelle, wire transfer. The only method that doesn't is cash. Using cash legally is your right. And follow the CBDC debate. This will directly affect how your money works in the future. Being informed is not paranoia, it's financial literacy. Your money moves differently now, faster and with a longer shadow. But the movement of money is only half the picture. There's another layer of monitoring that doesn't care how you move your money. It cares about how much sits in your account, key, and what flows in and out. And this next rule? This one's personal. Rule 4. The $600 spotlight. When your pizza money becomes a tax event. Let me tell you a quick story about pizza. You go out with 3 friends. The bill is $60. You throw down your card. 3 friends, Venmo you 15 each. $45 back. Pizza money, friend money. Simple. Now multiply that by a year. Splitting dinners, covering concert tickets, chipping in for birthday gifts, reimbursing your roommate for utilities. You're easily past $2,500 in Venmo and PayPal transactions. Maybe well past it. None of it is income. It's just life. Here's the problem. The IRS doesn't know that. Under the American Rescue Plan Act of 2021, Congress changed the $1099K reporting threshold for third-party payment platforms, Venmo, PayPal, Cash App. The old rule, platforms only reported if you received more than $20,000 and had over 200 transactions. For most people, splitting dinner tabs, completely irrelevant. The new rule slashed that threshold. The original target was $600 total for the entire year. No transaction count minimum. The IRS phased the rollout, 2024 at $5,000, 2025 at $2,500, but the statutory target in the law remains $600. A 1099K is an information return. It tells the IRS a platform processed a certain amount to your account. It does not automatically mean you owe taxes. Personal reimbursements are not taxable income, but, and this is critical, the burden of proof is on you. When PayPal reports $3,000 to the IRS and your return doesn't show $3,000 in income, the system generates a mismatch notice. You then have to prove those were personal, non-taxable transactions. Can you prove it? Do you have records showing every Venmo payment was a reimbursement, not a sale? Most people delete notifications without a second thought. And this doesn't just affect casual users. It hits anyone who sells used furniture on Facebook Marketplace, old clothes on Poshmark, a single freelance payment through PayPal, $2,500 in gross receipts, not profit, gross receipts. And you're in the reporting system. What you do: separate personal and business payment activity immediately. Personal Venmo for friends. Separate account for anything commercial. When sending money to friends, use the personal or friends and family designation, not goods and services. That distinction matters. And keep records. Screenshot your transaction history at year-end. Note which payments were reimbursements and which were for goods or services. When a mismatch notice arrives in 18 months, you want documentation, not a scramble to reconstruct a year of transactions from memory. This is a reporting rule, not a tax rule. You don't owe taxes on reimbursements regardless of the threshold, but you owe the IRS an explanation when their records don't match yours. And explanations without documentation are just stories. Your pizza money is now in the Federal Information System. Congratulations. But digital dollars through payment apps are one category. There's an entire asset class Congress has been trying to bring under the reporting umbrella for years. And in 2026, the net finally closes. Rule 5, the crypto reckoning, Form 1099-DA, and the end of the gray zone. For years, cryptocurrency existed in a reporting gray zone. The IRS said crypto was property. They said gains were taxable. They said report it. But the actual enforcement mechanism, exchanges automatically reporting your transactions the way your bank reports interest income, didn't exist. Not really. If you bought Bitcoin on Coinbase in 2019, sold it at a profit in 2021, and reported the gain, you were following the law. If you didn't report it, the IRS had limited tools to catch you. Exchanges were inconsistent about what they reported. Some sent 1099BS, some sent 1099KS, some sent nothing. Decentralized platforms sent absolutely nothing because there was no entity to send it. That era is ending. The Infrastructure Investment and Jobs Act of 2021, the bipartisan infrastructure bill, included a provision most Americans completely overlooked. Section 80,603 expanded the definition of broker to include crypto exchanges and mandated reporting via a new form, the 1099-DA. The 1099-DA, digital asset, requires brokers to report gross proceeds from digital asset sales, the customer's cost basis where available, and the resulting gain or loss. It's the crypto equivalent of the 1099B your stock brokerage sends for every trade. The reporting requirement takes effect for transactions occurring in 2026. In early 2027, millions of Americans will receive a 1099-DA for the first time. The IRS receives identical data simultaneously. Practically sell $500 of Bitcoin on Coinbase in 2026, they report it. What you sold for, what you paid, the gain or loss. If your return matches, nothing happens. If it doesn't, the same automatic mismatch flag as stocks as 1099K payments. No human required. The more controversial piece involves DeFi. The IRS proposed expanding broker definitions to include front-end service providers, the websites people use to interact with decentralized protocols. The industry argues DeFi protocols are software, not brokers, and centralized reporting from a decentralized system is technically impossible. Legal challenges are ongoing. The centralized exchange reporting is moving forward. The DeFi rules are in flux, but the direction of travel is clear: what you do. Assume every centralized exchange transaction from 2026 forward will be reported to the IRS. Track your cost basis. This is the most important thing you can do. The cost basis is what you paid. If you can't prove it, the IRS may assume zero, and your tax bill on that sale multiplies several times over. If you use DeFi, keep your own records. Transaction hashes, wallet addresses, timestamps, dollar values at the time. Until the regulatory picture clears, documentation is your best protection. Consider working with a CPA who specializes in digital assets. Staking rewards, airdrops, forks, NFTs, cross-chain bridges, each has different treatment, and getting them wrong is expensive. The gray zone is closing. Whether you think that's fair or overreach is irrelevant to the mathematics. What matters is that you know it's coming and you're ready when it arrives. Now, Cash, deposits, digital payments, crypto, all tracked, reported, monitored, or about to be. But there's one last place people keep valuables that they believe is completely private, completely secure, completely off the grid. They're wrong about that too. Rule 6. The vanishing vault. Why your safe deposit box isn't safe. Safe deposit boxes. The thing your grandmother told you to get. The locked metal box in the basement of your bank where you keep your birth certificate, your gold coins, your grandmother's jewelry, and the one document you never want anyone to see. Safe, secure, private. Except it's not insured, it's not guaranteed, and the box you've been renting for 15 years might not exist next year. Here's what most people don't know. The FDIC does not insure the contents of a safe deposit box. It insures your deposits, checking, savings, CDs, not gold, jewelry, documents, or cash stored in a vault. If your box contents are stolen, damaged, or go missing, the bank's liability is whatever the rental agreement says. And most agreements cap liability at a fraction of the rental fee, or disclaim it entirely for events beyond the bank's reasonable control. But the physical risk isn't even the main problem. The main problem is that the boxes are disappearing. Since 2010, more than 5,000 bank branches have closed across the United States. Every year, fewer physical locations. And every branch that closes takes its safe deposit boxes with it. When a bank closes a branch, it sends a notice to box holders, typically 60 to 90 days to retrieve your property. That notice goes to whatever address the bank has on file. The address you gave when you opened the box. If you've moved and didn't update, that notice is going to a stranger's mailbox, or nowhere. Miss the deadline? The bank drills your box, inventories the contents, seals them in an envelope, and turns them over to the state under unclaimed property laws. Escheatment. Your gold coins, your important documents, your family heirlooms, sitting in a state unclaimed property warehouse cataloged as abandoned assets because you moved and forgot to update your address at the bank. Some states are aggressive about timelines. Depending on the jurisdiction, box contents can be classified as abandoned after as little as 3 years of inactivity. 3 years without contact between you and the bank about the box. Not 3 years of unpaid rent. 3 years of no response to a bank communication you may never have received. And here's the final point. There is no federal regulation governing safe deposit boxes. None. They're regulated at the state level, and state laws vary enormously. Some states require banks to attempt contact multiple times before drilling. Others require just one notice. Some hold drilled contents for years. Others move quickly. Your safe deposit box is an uninsured, unregulated, impermanent storage arrangement governed by a contract most people never read, at a location that may not exist in 2 years, protected by state laws most people don't know. What you do: read your rental agreement, update your contact information specifically for the box, which may be separate from your checking account records. Consider a UL-rated home safe for round-the-clock access without depending on a bank branch. For critical documents, maintain digital backups in a secure, encrypted location. For high-value items, look into private vault facilities. Independent companies specializing in secure storage outside the banking system with higher insurance limits and no connection to branch closure decisions. The vault is vanishing, and with it, one of the last places Americans stored valuables outside the digital tracking system. The reality check. The pattern nobody asked you to see. Let's stop and look at the full picture. 6 rules. Each one, individually, is a regulatory adjustment. A policy update, a revised threshold, a new form. Incremental stuff. Bureaucratic machinery doing what bureaucratic machinery does, but side by side, a pattern emerges. Cash withdrawals, monitored and flagged below the reporting threshold. Bank deposits, insured to a limit with no guarantee of extraordinary protection beyond it. Payment infrastructure, faster, digital, fully recorded, 24/7. Personal payments, reported to the IRS at a steadily declining threshold. Crypto transactions, entering mandatory broker reporting for the first time. Physical storage, uninsured, unregulated, and disappearing. Every channel through which your money moves or sits is becoming more visible, more documented, and more reported. That is not an opinion. That is the trajectory of every regulatory change we've discussed today. This is not a conspiracy theory. No one sat in a room and coordinated this. These rules come from different agencies, different acts, different years, and different administrations. Some bipartisan, some executive, some regulatory guidance that required no vote at all. But the cumulative effect is the same. The financial privacy that Americans assumed was default. The idea that your money is your business unless you do something wrong, is narrower today than it was 5 years ago. And it will be narrower 5 years from now than it is today. That's not fear-mongering, that's reading. The tightest cages, 3 states where every rule hits harder. Not all of this lands equally. Federal rules set the floor. States build on top. New York, the most aggressive financial regulatory environment in the country. The Department of Financial Services imposes additional reporting requirements beyond federal mandates. BitLicense adds an entire compliance layer for crypto. And New York's unclaimed property law has one of the shortest dormancy periods. 3 years of inactivity, and your safe deposit box contents start the escheatment clock. If you live in New York and you're not tracking every rule in this video, you're exposed on multiple fronts at once. California, a privacy paradox. Some of the strongest consumer data protection laws in the country, CCPA, CPRA, but simultaneously extensive financial reporting requirements. The DFPI maintains active oversight over banks, fintech, and payment platforms. Layer that over insurance market instability, housing finance disruption, and some of the highest state tax rates in the country, and federal rule changes hit harder because the existing state burden is already heavy. Massachusetts, one of the oldest banking regulatory traditions in the country. The Attorney General's office pursues aggressive consumer protection cases. The Shield, 7 things you can legally do right now. Enough diagnosis. Let's talk about what you actually do with this information. Everything I'm about to list is legal, documented, and available to any American with a bank account. This is not evasion. This is not avoidance. This is informed financial management using the rules as they exist. 1. Split your deposits across multiple FDIC-insured banks. Do not keep more than $250,000 in any single ownership category at any single institution. 2. Use FDIC ownership categories to maximize coverage. Individual, joint, revocable trust, retirement, each carries its own $250 limit at the same bank. A married couple with properly structured accounts can be insured for well over $1 million at one institution. Learn the categories. Use them. 3. Add a credit union as a secondary institution. NCUA insurance at $250,000, structurally independent from the FDIC, genuine diversification, not just spreading money around. 4. For large deposits, use the IntraFi network. It distributes your funds across participating banks automatically, each portion under the FDIC limit, while you maintain one banking relationship. 5. Separate personal and commercial payment accounts. Personal Venmo for friends. Business account for sales, freelance, anything commercial. Clean separation makes clean tax filing. 6. Track your crypto cost basis starting now. Do not wait for the 1099-DA to arrive. Document every acquisition. Download exchange history, reconstruct from emails and bank statements. A CPA specializing in digital assets can help you build defensible documentation. 7. Audit your physical storage. Read your safe deposit box agreement. Update your contact information with the bank. Check your state's escheatment timelines. Consider a UL-rated home safe and encrypted digital backups for critical documents. These are not exotic strategies. They're not loopholes. They're the informed application of existing rules that most Americans never learn until something goes wrong. Don't be most Americans. The one thing, this week, if you do nothing else after watching this video, do one thing. Call your bank this week, not next month, this week. Ask one question. What is my exact FDIC coverage across all the accounts I hold at this institution? Get the answer in writing. Email, printed statement, anything you can file. That phone call, 5 minutes of your time, will put you ahead of 94% of the people watching this video who will do absolutely nothing. 5 minutes, one call, make it. Closing 6 rules, 6 changes, 6 things that directly affect your money, your privacy, and your access to your own financial life. None of this is classified. None of this is hidden. It's published, documented, and available to anyone who reads regulatory filings for a living, or anyone who watches this channel. If this was useful, subscribe, hit the bell, and leave a comment.